Hello, and welcome back investors. Today's video is more geared at our younger generation, which has an unbelievable amount of time on their hands compared to the rest of us, and hence has a distinct edge in terms of investing. We still don't understand why schools don't teach our children how to handle money properly, and we believe that they will not be teaching it in the near future. So, finance wisdom will always have a job to do. Now that we've finished criticizing our educational system, let's get to the video, which is how to invest as a teenager. Because when you start investing regularly at a young age, you give your investment more time to grow with the help of compound interest, which is one of the most advantages teenagers can receive for their investments. Most personal finance coaches recommend starting early and allowing your investment to grow until you're retired. So, where should you put your money in order to get the best possible returns? Let's find out. Before we get into the specifics, please remember to hit the like button so that the video may reach a wider audience. You can also subscribe to our channel to get alerts whenever a new video is posted. During your adolescent years, the most important thing you can do is make an investment in yourself. This may pay off far better than the profits you would get from stocks or other types of investments. Typically, your dreams and aspirations change as you grow older. For example, you may want to be a singer at 15 years of age, but when you reach 25 years of age, you may want to be a businessman. However, this should not prevent you from learning new skills at a young age. Any skills you learn will undoubtedly benefit you in the future. A lot of people have asked us if it is a good idea to just follow your passion instead of going to university. Let's move on to the second thing you may do to make money, which is to invest in stock market. Even though you will not be making much money as a teenager, you can begin your investing journey by purchasing a small number of stocks. Additionally, with fractional shares available in most brokerages, you can even purchase it with a very small amount. However, if you are under the age of 18, you will not be able to open your own personal brokerage account for the purpose of purchasing stocks. Alternatively, you may create a custodial account, which is a specialist brokerage account opened and controlled by your guardian or parent on your behalf to get over this hurdle. You will assume ownership and management control of your brokerage account as soon as you reach the legal age of majority, but selecting a stock is not as simple as you might think, and it will take a significant amount of time and effort. However, if you are confident in your ability to research and purchase good companies with long-term perspective, go ahead and give it a shot. For example, one of the problems that we see among teenagers is that they want to get rich quickly. They want everything now. As a result, they frequently get into intraday and swing trading in order to make quick money. However, we assure you that if you enter trading with this mindset, it will ensure that you stay poor. Anything done with a short-term perspective will remain short-term. This is not to say that you cannot make money in trade. However, statistics show that over the long run, the vast majority of traders do not, which means that your chances of winning are higher if you invest for the long term rather than trade for the short term. If you are someone who does not want to deal with refinancing reports and other tedious tasks, we offer a better solution for you. Low-cost index funds, for ETFs, also known as low-cost index funds. Individual stocks have the potential to generate higher returns, but they also carry the risk of losing all of your investment money in the event that the stocks in which you have invested decline in value. If you want to play it safe while still earning a reasonable return on your investment, you can invest in a low-cost index fund or ETF, which are mutual funds that track the performance of the stock market. Investing in low-cost index funds allows you to diversify your investments across a large number of companies that make up a specific index. For example, an index fund that seeks attractive returns on the S&P 500 index will invest your money in stocks of companies that make up the S&P 500 index. By distributing your assets over 500 different firms, you can lower your investment risk. The Standard & Poor's 500 index has historically delivered an average annualized return of 10%, making it an excellent long-term investing choice for young investors and teens looking to accumulate wealth. Alternatively, you may invest in exchange trading funds or ETFs, which operate in a manner similar to that index funds. There are many different types of ETFs available, including equity, bond, commodity, and currency ETFs, which give you exposure to different asset classes depending on the type of ETF you choose. Additionally, long-term gains in the money you invest in your teenage years will grow into a large mistake in your 30s, 40s, and 50s. Let's take a look at our third alternative, which is Real Estate Investment Trust or REITs. Real Estate Investment Trust or REITs are corporations that own, finance, and manage income production real estate properties. Most REITs are publicly traded on stocks exchanges in the same way that stocks are traded to gain exposure to the real estate market and diversify your portfolio. You, as a teenager, should consider investing in REITs with your coastal funds. Your brokerage account, in contrast to Real Estate Investment Trust or REITs, is extremely liquid due to the fact that they are traded on stock exchanges. As a dividend investor, you may also benefit from the dividend income that is given out by REITs. The fourth point to remember is to avoid stacking up student loans. In the event that you are successful in keeping your student loan debt under control, you will be able to safeguard your financial future and avoid sliding into a debt trap. Investing each dollar you save on your student loan is analogous to decreasing your student debt by $1. As a result, many teenagers do not understand the importance of staying away from student loans and end up burdening themselves with an overwhelming amount of debt while paying high interest rates on the outstanding balance. If at all possible, we strongly advise you to avoid taking out any student loans. Lastly, starting a small company might be an excellent option. The idea is to teach teenagers the fundamentals of business and to assist them in learning the process and various steps from purchasing supplies to value addition to marketing and selling products for profit. Teenagers can choose to reinvest the profits in their business for growth, or they can withdraw the profits to fund their studies. Teenagers should start small so that even if they lose money, they will not be out of pocket much money. The majority of large corporations that we see today started out small and gradually grew and achieved success. Once you've established a reasonable profit on your time investment, you can always try to expand your business in order to generate a higher and more sustainable profit, thereby growing it into a larger enterprise. In conclusion, investing early always reaps benefits, including greater compounding effect and a larger sum of money at the time of retirement, even if the rate of return is modest. When the habit of saving and investing is instilled in teenagers at a young age, they will gain financial literacy and will be able to make smart decisions that will lead to financial independence. The fact that you're watching this video as a teenager gives you a leg up in your personal finance career.